I think the adjusting macro was the shot in the arm we needed to realize, do the hard thing first, go after the hard thing, because once you figured that out, the rest becomes easier. And that was really the thought process behind our approach.
In today's episode, we dive in deep on how to find fast-moving and importantly also profitable waters in the earliest days of startup building. A strong customer pull doesn't always come with a sustainable business model, which is incredibly important to get right for the long-term success of a business. Our guest today is Basile Senesi, the Chief Revenue Officer of ARC, the financial operating system for growth companies looking for cash management built for scale. To date, ARC has raised over 180 million in debt and equity from the likes of YC, Bain, NFX, Torch, and Leftlane. As for Basile, he's been building up ARC's revenue function since the earliest days when they came out of YC, which he had done multiple times prior, including at companies such as Phonebox, which has raised over 500 million to date. On top, Basile is a prolific angel investor in LP and venture funds, as well as the owner of Chateau Pavo, a Sonoma winery focused on biodynamic wines that blend old world methods with new school flavor. I've ordered wines from his winery before and I can highly recommend giving them a try. Basile has a ton of experience building startups from the ground up, and I can't wait for you to learn more about his very methodical approach to how he thinks about operating startups in today's episode. With that, welcome Basile. It's wonderful to have you on. And today's topic is an exciting one. Let's zoom in on what finding fast-moving and importantly, also profitable waters during the earliest days of startup building mean for you. Maybe to set the context for our listeners, bring us back to the earliest days of ARC when you joined right after YC, a time when ARC was a very different company to what it is today.
Yeah, it's crazy to think back to those days because, to your point, the business looks so dramatically different. Back then, we were a lean revenue financing, balance sheet heavy player. We played in the loan space, providing revenue financing to software companies, many of whom were our batchmates in YC and YC companies more generally. And we made our money by lending out to those companies and collecting interest on those payments. Very different business than the one we have today. We've evolved that business quite a bit over the past few years.
Thank you for that. And so what I understand is, right, early on, you talked to a lot of customers within YC, outside of YC, and you actually got really strong feedback from these customers around what you were building. And it would have been easy to take that as early signs of product market fit and run with it, but you guys actually didn't. So walk me through what happened, right? What the kind of feedback was that you guys got and why you thought you had product market fit, but then also why that led you to actually, or what caused you to then say, this is actually not it.
Yeah, it's interesting because lending is one of the very few lines of business where demand doesn't necessarily correlate to product market fit, to PMF. The art of the loan industry and more generally balance sheet lending, fintech, is finding people who want your loan product and then making sure they can pay you back and that you can service them profitably. And unfortunately, learning whether or not they will pay you back takes time. By default, you need to give them money and see those repayment cycles play out to know whether or not that demand can be sustainably handled. When we started the business back in late 21, the theory was we want to start with something that is relatively easy and quick to get off the ground, that does not need a ton of engineering lift ahead of validating demand, and then ultimately to build into demand. And so by taking a loan type business, one of the many things that we knew we wanted to do with ARC from day one, we picked the call it like sub vertical that was relatively easy to validate. And that validation at first came in the form of just a tidal wave of software demand. We had, all of our batchmates interested in this product. We had a number of later stage companies interested in this product. We quickly went from lending off our balance sheet to raising a credit warehouse to book even more loans. And I think we realized pretty quickly as all this was happening that the demand was there, but that demand might also be a corollary to real potential warning signs in the broader market. Go back to early 2022, the world looked very different than it did today. Interest rates were still at 0%, or effectively. We were still following the 2021 hype cycle, the zero interest rate kind of phenomena, startups that were continuing to grow without necessarily a focus on sustainability or long-term default to life kind of economics. And so we were seeing this demand as a bit of a bellwether alongside these other macro indicators, discussion around rising rates, slowdown in growth, um, geopolitical uncertainty, et cetera. We viewed all of that as a signal that things might sour. And so we had a long, hard discussion. We said, do we want to keep building this business into this demand curve? We can. We know how to do it. We've become very good at doing it. We have a really strong sense that there's real money to be made here, and there's a real customer problem to be satisfied here. However, what happens if the worst pans out? If the macro does lead to an environment that is less favorable, less conducive to continued growth for our business in a profitable way. And I think the reality is the team that is behind ARC comes from this world, comes from this background, has seen macro cycles play out before, has seen the writing on the wall, and has lived through very painful credit adjustments. The most recent of which, we might have all forgotten, but was in 2020 when the pandemic broke out. And we did not want to get caught flat-footed. So we took a long, hard look at the business and said, what do we want this business to be? I think the reality is, it was always going to be more than lending. We started with lending as the wedge to building a broader platform that would satisfy many different needs of the CFO. And so very quickly we said, maybe this isn't the right wedge for us, even though demand is there. It might actually be a long-term negative to this business if we go too far ahead of ourselves, if we get too over our skis on this. Fast forward a year or two, we might be carrying a loan book that isn't sustainable. And so what do we do? So we had to kind of make those decisions pretty early on. But, I think now very fortunate, although at the time it felt very unlucky, to have been creating this business at arguably one of the hardest kind of macro adjustments in software startup history, or at least recent history. And we were able to, I think, extract the lessons very quickly from that and make the right decisions for ARC.
That's fascinating and so many things to unpack here. Maybe we're just kind of early on to give us an idea around how tough it was to make those decisions. It's always a question about what does actually strong demand mean in startup world, and every startup experience is somewhat different. Can you walk us through just how much demand there was for the lending product and how much pull you got from the market to give us an idea around the challenging discussions you needed to have internally to eventually kill this golden goose that you found this early on in the trajectory of the company?
Yeah, I can give you a couple of different indicators we used to look at to speak to kind of the velocity we were seeing for the product we were building. First off, there were market comps, right? We were not unique in solving this problem. Other players were solving it, arguably in different ways, but tackling the same issue. We were one of the early rising, kind of upstarts at the time in the market doing this. But companies like CapChase and Pipe had gone to dizzying valuations off of similar business models and proved that there was real demand in the market. So I think comps were there. I think number two, some proxy metrics we would look at. We came out of YC in March 22. We raised our Series A in July 22. The investor appetite for what we were doing directly correlated to the demand we were seeing, the revenue growth we were enjoying, I think speaks to how quickly things were getting off the ground and how much excitement there was about that. Parallel, we raised our first, senior credit facility to power our loan business within 6 months of originating our first loan, which is pretty rare and pretty difficult to do. And it was a very high quality credit facility at arguably one of the weak points in the market. We closed on this facility in, I believe, April or May 22 as well, to the tune of $100 million from a seed stage company that, virtually didn't exist a year prior to that. And this was not a 2021 deal. This was market tightening 22 deal. So there was just a lot of signals, I think, out there that speak to that. But probably most importantly is actual customer demand, right? We aren't talking about, SMB loans to the tune of $10, $20, $30,000. We're talking about hundreds of thousands of dollars, if not millions of dollars, in credit facility sizing to the customers we were supporting. We were supporting customers from late seed all the way up to Series B with this revenue financing solution. And, we were doing, ultimately at our peak, we originated close to 100 million bucks, basically turned over almost the full facility, um, while this program was running. So demand was real. I'd caveat for the folks who know, in the audience that even though we ultimately made the difficult decision to, adjust the business and, chase different types of revenue lines, this business actually ended up doing very well. Whether it would have continued to do so, we'll never know. I believe personally that it was the right call and that, taking on more liability during the peak of the market adjustment would have probably hurt. But of the loans that we did book before deciding to pull back, they performed incredibly well. And so I think the real hard lesson in all of this is if it's all going well, why didn't you continue? Um, those debates raged internally pretty hard for a while before we made those decisions.
Yeah, which is a great point, right? So you raised at a high valuation, very strong customer pool. I'm sure you've hired up, you're burning money. There's a lot of pressure to grow revenue exponentially. Um, so maybe help us understand how tough some of these internal discussions were, and what do you learn from having them at a time when everything seemed to be going incredibly well.
Definitely intense discussions, definitely hard discussions. And, I think the one core asset that we have as a business, I've already hinted at it once, and it's worth repeating here. We come from this world. We've seen the good, the bad, and the ugly of finance and fintech more specifically, how those businesses fare in the eyes of investors, how market sentiment hits finance and fintech companies particularly hard, and changes in that sentiment really can impact the trajectory of a business and how those businesses are perceived. Before it was cool, we were always talking about and thinking about and focused on unit economics and getting to profitability, even though growth was, of course, as a venture-backed company, a key metric that we chased as well. So we always kind of came from this school of you need to grow a business responsibly. You need to grow a business with unit economics in mind. And I think the reality is, as much as the debate raged, when we scenario planned out what the future could look like in a down market, it was very clear to see that we could end up upside down if we didn't make the hard and correct decisions. Growth is only one vector. The reality is, and we see a lot of fintech suffering from this today, in a balance sheet risky business like lending, the more you grow, the more you burn. And the more you burn going into a market where capital availability is decreased, the harder it is to keep sustaining the business at scale, unless you're the master of your own destiny and you can get to profitability. Well, that profitability inherently will be impacted by the health of your loan tape, of your customer portfolio, of the customers you've issued loans to. And so if you believe that capital will be more scarce, that customers, all things being equal, will perform less well, will be less likely to service the debt correctly over time, well, then you're kind of setting yourself up to fail, right? You won't be able to raise more, you won't be able to originate more, and you'll be burning cash, not just because you've issued loans and because you've grown your OpEx as you're growing the business, but also because customers aren't paying you back and you're putting equity dollars towards filling the gaps in loan defaults. It's hard. I think for us, while the debates were one between growth and unit economics and what do you have to believe about the future to make decisions around adjusting the business today, the scenarios didn't look good. And I think we collectively came to this kind of combined agreement that the right healthy thing for the business in the long run was the hard decision in the short term to rebuild growth in a different, more revenue durable line of business quickly, rather than try to see what might happen in a depressed market. We just did not like the idea of rolling the dice on letting the macro play out in one way or the other and hoping we were on the right side of it. And I think what we found very quickly is that all the companies who didn't make those decisions in 2022 that were in our category, in our space, I think many of them regret not having made the adjustments that they had the chance to make in the summer of 22.
Was it hard to convince the investors to kill the golden goose this early on?
It was, right? We raised them in our Series A on, to your point, the assumption that growth would continue. And it's ironic because, we came out of our Q1 board meeting, middle of Q2, and one of the lines that stuck with me was something to the effect of, "I'm glad we listened," said from one of our board members to Don, our CEO. I think, Don had the foresight that maybe some of our investors didn't quite have at the time, that they came around to eventually, and that they now recognize was absolutely the right call. But in the moment, we were, having to make decisions that from just the investor lens didn't necessarily seem like the right path. It was hard. I think the reality is, because we're experienced operators, we've also realized that out of respect for the investors who believe in our company and back us, we have a relationship with our investors, which is one of real deep mutual trust. We're not a company that, takes money from our venture partners and ultimately feel completely beholden to their decisions and let the board run the business. We believe that our combined expertise sets us up pretty well to understand the market as experts in our field, even better than the more generalized investors that we take on. We respect their opinion and we value it deeply, and we apply a lot of that advice and that expertise. Find the fast moving waters. That's a James Courier quote. One of the partners at NFX who sits on our board. We believe like the ethos of what they have to share deeply, and we have tons of alignment with them. But because we believe in their long-term success and we believe in our own expertise, we also want to know when to disagree. And I think in this case, the narrative sounded something like, trust us, the growth story will come back, will look even better, the revenue quality will look even better. And any company who doesn't make these decisions now will be regretting it 12 months from now. Believe in us. And they did. And I think we're the better for it.
So you were in a fast-moving water, but not a fast-moving, profitable water. Did you kill that fast-moving water? Did you get out of that fast-moving water before you found another one that was both fast-moving and profitable? Or at what point in kind of the rediscovery journey did you decide to get out of the first fast-moving water?
Yeah, thankfully, the platform vision for ARC was there from the very beginning. So while we started with on-balance sheet lending, we always knew what pillars 2, 3, and 4 would be. So when we decided to, effectively slow down on pillar 1, not kill it right away, but slow it down and kind of, throttle growth, it was in favor of accelerating the timeline on building our second pillar. And for us, that was cash management. So we raised our Series A in July. Immediately, those dollars went towards building the V1 of our cash management neobanking platform. Ironically, when I think back to those days, the simplicity of that product and what we were able to do in the market with it is remarkable considering how far it's come. But we had our MVP out by September of 2022. So within a couple of months, we built the first version of this banking app and started acquiring our customers. And so it wasn't a complete stop on the revenue financing business. It was a pullback. We started allocating engineering resources first, then sales resources, then marketing resources in favor of this emerging line of business while progressively divesting the other one. And I think, the reality is all of that was accelerated when the SVB crisis hit, and it was the real decision-making moment for us that confirmed two things. Imminently, the second pillar of this business was interesting, was valuable, had a lot of potential upside to it, and could very much replace the growth that we'd seen in the lending business quickly. But I think the other thing that also taught us that Black Swan event was a further signal that the markets were not stable and not strong. And while, we talk about the deposit crisis, the reality is it had knock-on effects to the broader venture-backed ecosystem that didn't bode well. While we saw, demand for our banking product increase, we also confirmed that there was continued pressure in capital markets and the credit space for tech companies. And it validated our decision to continue lightening up on that gas pedal and pursue the cash management business wholeheartedly. I think to answer your question, we pulled off on one gas pedal and stepped on the other. And I think one of the big lessons for me, ARC or otherwise, is a business should have more than one ways to win. We were fortunate to have at least two, and we were able to kind of throttle our investments in each correctly based on the market momentum.
What I find fascinating is also, right, kind of in the lead up to deciding what second kind of part of the business to focus on, is how methodical you guys were with regard to kind of figuring out what to actually bet on. Can you walk me through a little bit kind of the process that you went through to eventually validate, right, that cash management is the idea that you want to bet the future of the company on, at least the foreseeable future?
Yeah, look, I think the reality is fintechs who have performed well have generally been pretty close to the metal, and close to the core things that their customers care about, and pick the right entry point into those customer relationships to then expand into other product pillars correctly. And I think when we thought about, okay, who is our customer and what is the problem that Arc is ultimately solving, we make the CFO's life easier, right? We make them spend less time managing the finances of the business so that they can spend more time actually running the business. And there's a lot of ways to do that. You can help with FP&A, you can help with corporate treasury, you can help on capital markets, you can help on a whole bunch of different things, on accounting, etc. When we looked at the core most kind of thing that seems to be the common language that impacts all these different things, it's what is the business's bank account balance today? If you are the bank account for the business, expanding into other things becomes a lot easier than if you're not. A parallel example to this that really comes to mind for me is Rippling. Why did Rippling win as much as Rippling has won? It's because in this like HR/finance management space, they picked the right entry point, and winning that entry point gave them a right to win everything else. By doing the hard thing first, in their case, payroll and benefits, you're able to capture the information you need to have the most complete picture of your customer and easily use that information to seamlessly offer additional services. Now, Rippling is coming after 5 different lines of business. They're going after Lattice on the employee review space. They're going after arguably the card business, is the rumor of a couple of other fintechs. They're going after, potentially Carta and Pulley and all the other cap table management platforms because they entered the relationship with the right surface area to offer other things. For us, the CFO suite cares about one thing more than anything else at the end of the day is what is the dollar figure in the bank account? And the closer you are to that, the better it is. We didn't want to start there initially because we believed that building that product would be capital inefficient, would take a lot of time, would be really complex. There's regulation. There's like very little tolerance for pain when it comes to how well the bank account works if you're a CFO. So a lot of just considerations that make it a hard wedge to build. And things like capital felt like an easier wedge at the beginning. But I think the adjusting macro was the shot in the arm we needed to realize, do the hard thing first, go after the hard thing, because once you figured that out, the rest becomes easier. And that was really the thought process behind our approach.
That makes sense. And I think as you were thinking through that, you made a lot of assumptions kind of around, right, what it would take to get in and get the CFO's interest and build that for them. One of the things that stuck with me in our discussions is you telling me that basically everything is a funnel and you don't necessarily need to have the product ready and sell it to customers in order to figure out whether there's demand. Can you walk me through how you're thinking about kind of the funnel approach as you're validating your ideas and how you guys did it?
There's a funny like teaching, right, in business and like leadership courses and stuff like that they talk about like the example of making a sandwich, making a peanut butter and jelly sandwich specifically. It's basically ask people how they make a sandwich, and you'll find 2 different kinds of answers: the very basic ones and the very detailed ones. One answer will be grab bread, take the thing, spread it on it, cut the sandwich, and eat it. Other people will tell you, walk to the fridge, open the fridge, reach for the jar, pull the jar out, open the lid, so on and so forth until you have the final product. And I think a lot of that applies to go-to-market execution in general. The more thoughtful you are about the steps in the process, the more assumptions you can make about what it takes to go from the very first touch point to closing a customer and retaining them. The more you try to understand those steps, the more you can understand what assumptions are not holding true, what things are falling apart, what things are not panning out the way you expected, so that you can learn quickly, correct, adjust, solve those problems, and get to a better, more efficient outcome. You hear this parallel a lot too in early stage ventures. I'm sure you have come across. There's this debate of pre-seed, pre-revenue founders shouldn't build an operating model because, like, what's the point? You don't know anything about the future. You have no assumptions yet that are grounded in any reality. Why are you forecasting revenue? I disagree with that statement. Not because I disagree that it's technically not useful in pointing out the future. I think that's true. You don't have actuals, so how can you forecast the future? However, to me, when I talk to a founder who goes through the disciplined effort of creating a forward-looking operating model, what I'm really looking for is what their thought process is for going from no revenue to revenue. What assumptions are they making about how the business will evolve in the year ahead, 2 years ahead? And what assumptions are they making about how things will progress through every step of the customer journey, all the way to customers being won and retained? And the ones that are really good at this view the model not as a roadmap, but rather as a bit of a sounding board to their own thought process to be able to tailor and adjust their expectations along the way. So I think for us at ARC, right, we kind of have this approach of, look, we can back into a target based on some pretty simple math. We raised at X, we have Y amount of cash, we're going to spend Z amount of dollars. And so that probably means we need to hit this target. Great. How do we get to this target? How do we go from like dollars in the door to how many customers we need over what period of time, how many opportunities we need in order to get there, where those opportunities are going to come from, et cetera? We start with a model in mind, not because we believe the model actually tells us a story about the future, about the world, but because it helps us document our assumptions and constantly reforecast those assumptions as things prove to be right or wrong. Maybe I thought conversion rates on first touch leads is going to be 3%, and I learned that it's only 2%. Well, that can have a pretty material impact on the assumptions that I have downstream from that. Well, great. When I learn that, I can reforecast the future, keep the end number fixed, and kind of back into what you have to believe in this adjusted funnel view to get to that goal. Maybe now I need more leads. Same thing. Let's take sales and marketing efficiency. Maybe I believe that my sales team can do 5x, their OTE in terms of gross profit generated. That's great. That's market standard. Well, the reality is I might learn that based on the growth trajectory we have, we can grow faster if we sacrifice S&M efficiency a little bit, and we can bring that down from 5 to 4. Well, what does that now do to all of our other pictures? Our burn picture, our multiple picture, and of course, our customer acquisition picture. So just having the levers documented, having the customer journey really thoughtfully broken down into not just broad steps, but very specific key points in the life cycle helps you say, was I right or was I wrong? And if I was wrong, what happens if I change that wrong assumption to now the right one, the one that's confirmed by data? How does that change my future picture? What else do I need to change to get to the same end target? That thought process, we try to apply very methodically across the business. And frankly, I chalk it up again back to our roots. Like, we come from a world that lives pretty close to the economic forecasted model. Applying that to this stage of a company is rarely done with the level of rigor that I think we apply to it at ARC, but it's paid off pretty well for us. It's helped crystallize, clarify, and constantly gut check our thinking so that we don't get too far in the wrong direction with no path to getting back on track when things that we inevitably believed were right turn out to be wrong. Just the story of building a startup.
That's fascinating. Maybe right, for someone who has never really thought about building such an operating model for a startup early on, kind of what advice do you give them and what level of detail are this? Because you can go almost like into an infinite level of detail. What's kind of the right level of detail for someone to do this in a way where it's actually useful versus just, right, hey, this is kind of how we get to $1 million in revenue in 6 months at a high level?
Totally. So I think there's two broad categories within that. So there is how you come up with that model in the first place, and then what you do with it over time, right? How you come up with the model, I like to kind of take two approaches. I go bottoms up and top down. What I mean by bottoms up by top down, let's start there, is based on a revenue number, what do you think will happen in order to get to that revenue number? That is like, we need to hit 6 million in ARR. We believe a customer will be worth X. So that means we need this many customers. We need to be at this level of revenue by this date and this other level of revenue by that date. How do you break out like customer acquisition picture based on that timeline? And then you come up with a relatively basic funnel. We think we're going to be a direct outbound shop, which means we need to identify potential targets, contact them, get them to respond, schedule a meeting, convert the meeting to a qualified opportunity, work through negotiation, work through, paper, and then get them across the line, sign a contract, and onboard it. You can kind of map out those funnel steps pretty clearly. That gives you a sense of what does it take to create one unit of customer. How long do we think each of those things takes? That tells you when you need to start in order to get one unit of customer. And now you kind of know, right? Top down, we said this much revenue, which implies this many customers, which implies this many inputs at every step of the funnel need to happen. You kind of just work your way backwards until you get to the very beginning. What is like the market that we have to go after, and what portion of that market do we have to get in front of? That can inform your headcount plan. It can inform your channel strategies and where those leads and those potential customers come from. It can also inform whether your business model is realistic based on your addressable market. Because if all of a sudden you're finding that you need to, talk to 10% of the market just to get to 6 million in revenue, it might be pretty hard to build a sustainable long-term business off of that. But that top-down approach is really just starts with a revenue target in mind, a customer value assumption against that revenue, and then you kind of work your way down. Then you flip that around to the bottoms up. Forget the revenue target. It's what do I think a person can do? And how many people do I need in order to get to a certain revenue target, right? There's both actual history here that you can use, and then there's best practices. There's benchmarks. There's like what you see in the market. A rule of thumb, at scale, a business should probably be taking a salesperson and creating 5x that salesperson's cost in terms of net new annualized revenue. That's the dream, right? Now, the assumption is the faster you grow, the less efficient you'll be generally. And the more those two things can move in tandem, the better. But maybe you don't start at 5x. Maybe you say year 1, it's going to be 3, year 2, it's going to be 4, and year 3, it's going to be 5. You have this like picture of what is my sales cost relative to my revenue target? What do I believe one person can do? And like, how do I build kind of towards this picture? And then what you end up trying to do is you marry the bottoms up and the top down approach. Maybe the bottoms up approach tells you I need to hire 150 salespeople, but your top down approach says that like that might not be that might not hold value, like that assumption might not work because maybe the company didn't raise enough cash to do that, or because the speed at which it wants to get there doesn't allow you to do this. You kind of triangulate, you constantly figure out, adjust those two assumptions on both sides and say, okay, if I change this on the bottoms up or this on the tops down, how do we get a little bit closer to a picture that makes sense? You build towards a model that becomes the kind of governing early model for the business that says, this is what we commonly agree on, we commonly believe, we think is the realm of the possible. And then we're going to work against that. We're going to start chipping away at our hiring plan based on that. We're going to start creating a marketing plan based on that. We're going to start creating, a product roadmap that speaks to like revenue expansion based on that, et cetera. And then reality happens. So now you have your model and like it's time to go. You're going to learn pretty quickly what held true and what didn't. I'm a big believer in measuring, especially the leading indicators of revenue, as tightly and as frequently as possible. That means I'm not going to find out for a long time how many dollars per customer we generated, because by definition, that takes time, right? But I don't want to wait that long to know if I'm on the right track or not. So this is where your model comes in. You start to think about, okay, well, we said we were going to talk to X amount of customers per week. Are we doing that? We said we were going to reach out to Y amount. Are we doing that? Why not? Great. That becomes a point of reforecast. We thought we were going to talk to 20, but we talked to 17. What happens if we make 17 the going forward assumption? What happens downstream? Now, a couple of weeks goes by, you've learned something else. We've talked to 17 customers a week for the last 4 weeks, and we're realizing that 50% of them want to continue forward to an actual demo and conversation. Well, we thought that number was going to be 42%. Well, great. So far, we're doing better. What happens if we reforecast at 50%? And every couple of weeks, you kind of pick a point further down the funnel to figure out if that one assumption is holding true or not. And you, of course, continue measuring the things that are also upstream from that to see if they're changing. But the idea is you just learn about your sales process and your funnel, starting with the earliest leading indicators, so that you can constantly gut check the forecasting assumptions that you've made and see whether or not you're likely to perform against them while you still have time, while you still have runway. I talked to a company in the defense space, so very different market. But this is a couple of weeks ago. And the guy told me, look, we raised, 3 years worth of cash. We have a 1.5 year long sales cycle selling to DoD, and it's like very complicated. And it took us a full length of that sales cycle to realize we were doing the wrong thing. So we burned 50% of our runway. And by the time we got to that point, we realized, man, that is a very expensive lesson. We should have known that we were on the wrong track no more than 3, maybe 6 months into this process, not 18 months into this process. If we had known that, we would have made the same decisions we're making now, but we would have made them a year earlier, and we would have a whole extra year to get to our revenue targets. Now it's looking very hard because we have to make burn assumptions and burn reduction decisions that are going to negatively impact our ability to grow revenue. Well, we would have been in a much better place if we still had cash on hand to continue seeing this adjusted strategy through that is now starting to pay off and pan out. So I think like those decisions are so important. Time is so important in a startup. By definition, you don't know if it's working until it's worked, and that takes time. If you're waiting that long to readjust your view of the future, you might run out of road. And I think that's what we're constantly trying to avoid at Arc.
What are some of the signals, right, that either this defense company could have missed or right that they could have picked up on earlier? What are some of the signals that you potentially picked up on early on that made you change the direction to not run into that issue, right? That he wasted a lot of runway by not noticing things that he could have noticed?
I think it's a few things. I'm a forever pessimist, right? And so I always try to think about things from the perspective of why will this not work? Why will this deal not close? Why will this customer not sign up? Why will this model not hold true? I find that most of our commercial team, our salespeople, our marketers, et cetera, tend to be forever optimists. They look at it from the lens of why will this work? Why are they excited? Why is this deal going to close? So one big lesson learned from me is trying to teach my sales organization, the people who are talking to our customers, to come at it a little bit from the lens of why will this fail, and find all the reasons that something might fail and de-risk those things as early as possible. I think like what this, defense company found out in the process was that the founder was too far removed from the commercial conversations and was hearing the upshot, the positive feedback on the commercial conversations that were happening through his sales team, only to realize that actually a lot of the less favorable news wasn't really emerging until it was more crystallized as a no. And then like it was too late. So I think one of the big lessons is teach your sales team to be pessimistic. And I know that sounds sad and downtrodden, but the reality is if you think about all the ways it can go wrong, you'll solve for that rather than getting happy years and just hoping that a deal closes because like the call went seemingly well. And lesson number 2 is, stay very close to this customer, especially early on. This is particularly painful for technical founders who aren't necessarily commercial by nature, really trying to get as close as possible to customer sentiment with a pessimistic frame of mind, figuring out why it won't work is, I think, a very important lesson that, a lot of second-time founders get, having not done it the first time around.
That's fascinating. Now, maybe going back to kind of your decision to lean into cash management. You were exploring different potential products and you were running kind of this operating model approach for them. At what point in kind of that journey did you have the conviction? Because I'm assuming it's not, you hadn't closed your first customers on the cash management product yet. So at what point in this operating/funnel validation journey did you have the conviction that this was the way to go for Arc going forward?
Yeah, look, like any good founding team, we had a theory. And that theory was informed by research and a lot of potential customer insight. What I found amongst companies who go through YC is that there's a common culture and belief around just getting market insights and feedback from the horse's mouth directly as much as possible. Talk to as many customers as you can about the problem so that you can figure out if there's a company worth building against that problem or not. And we did a ton of that before the company was a company, right? Beyond our combined experience, the number of customer conversations that happened that informed this company's right to exist were through the roof. That there was, hundreds and hundreds of potential target customers that gave us feedback on this stuff. And a lot of that feedback informed that even though, the most modern tech companies out there were using cutting edge tools just about everywhere across their stack, the one part that continued to very much lag behind was the finance stack, was banking specifically. And so we knew there was an opportunity there. Then we wanted to validate what the shape of that opportunity looked like and what the shape of the solution to that problem could look like. And we actually opportunistically used our first wedge product to further deepen our understanding of what it would take to build the right version of a solution for the CFO. It happened that our first wedge was targeting the CEO who was wearing the CFO hat in early stage startups and the CFO at growth stage companies who was responsible for capitalizing the business. And we were able to just do a lot of customer interview and discovery. It sounded something like, what would it take for you to deposit these funds into a different bank account? And we realized there was a lot of different vectors for decision making. Of course, returns, of course, ease of use, but probably most important, most paramount, trust and the belief that the money would still be there when you needed the money, even though you were trusting an early stage fintech with that money, right? Um, and so we solved for that very quickly. We picked partners that we felt could convey trust. We picked sponsor banks that we felt could convey the same level of trust. We invested in building a team around this product that had expertise and roots in the space that came with trust. Um, but I think, just talking to would-be customers and then using our first product as a lead-in to the earliest set of kind of MVP customers for this newly built product was how we kind of accelerated. We growth hacked our way to launching.
And so maybe, right, taking a step back now, this was a very much kind of a roller coaster, hard process to get here. What were some of the major learnings for you personally or for ARC as a business, kind of now looking back at that, I guess, 12-month period or 18-month period that you went through?
Fintech is very hard. Um, there is a lot of, back to the model question, there's a lot of assumptions in a fintech model. It's not a straightforward business. You have to really want it to work and have to be really committed to addressing that complexity to build a durable quality business in this space. The flip side is the opportunity is also massive. And I think one of the things we very much got right was sizing the problem, sizing the pond that we were fishing in. There's a lot of companies who need what we're building. It's just a matter of getting in front of them with the right message and the right configuration of product to convince them that we are the right solution. So if you have a big market, and even if you have a really hard business to go after, and you're methodical and thoughtful about your approach to going to market, you'll win in the long run. Companies that fail take shortcuts. They take shortcuts and they oftentimes ignore the warning signs that could be, signs that the business will not fare well in the long term. For us, right, it was the early lessons of pull back on capital while the markets are still okay and before things get worse, and invest instead in another product pillar. But that pessimism that I talked about, that belief that, you should be willing to make the hard decisions and not ignore the warning signs, is probably one of the biggest lessons I take away from all this. I think probably finally, and this is challenging because it's somewhat antithetical to venture in the first place, but we both live in a world where growth and speed are paramount. The faster a company grows, the better a company is doing, the better valuation is, right? Like the rough math is how much money are you making? How quickly is that growing? And that's how we think about pricing a business. The reality is not all revenue is created equal, and growth oftentimes can be detrimental to revenue quality in the long run. And so I've learned to put a lot of emphasis in growing the business the right way. I always believe that, but I think the last 2 years have really taught me the importance of that. We're seeing, comps in our space who continue to prioritize growth above revenue quality now struggling to think about continuing to capitalize their business, raise their next round, and continue to building their solution for their customers. Well, we took the hard decisions early and made adjustments. We're now benefiting from that. And I think that was a very good kind of lesson in doing the hard thing, even if the hard thing sometimes goes against the common advice of the average investor and what they want to see in a company. Trust your gut and believe that you're an expert in this and that you're willing to make the hard decisions. And I think you'll get there.
That makes a lot of sense. Like this wasn't your first rodeo, right? You've built startups before. Yet knowing what you know now after this process, are there things that you would do differently kind of throughout this journey?
It's a very, very good question. every parent will tell you that every kid you have teaches you something new about being a parent, right? And no matter how many kids you've had, the next one will always keep you on your toes. I think startups share a lot of the same attributes and qualities. They're all very unique in their own way, both because the products are unique and because the timing in which you're building these companies is unique. I think I've learned a lot from these various startups. What I would now do differently, enriched by my experiences at Arc, is make sure that I'm picking a early group of people who are so fanatically motivated about making this business work that they will take the pragmatic, pessimistic lens to building the business with me rather than chase the short-term milestones and be forever optimistic about those milestones at the expense of the long-term viability of the business. I think if I translate that a little bit more clearly, hire people who want to be in it for the long haul and who are willing to slog through the hard times with you as early as possible, rather than the people who are chasing a Series A or a Series B or another milestone, because the reality is there's a lot more bad days than good ones. The good ones far outshine the bad ones, but you want somebody who's not only fueled by the wins and who's able to be fueled by the journey and the vision. Um, that's what it takes, I think, to push through all the hard stuff that comes with building an early stage startup. And the reason I learned that more from Arc than anywhere else is this was the hardest market to build a startup in my professional experience. And we saw the 10Xers from the detractors very clearly. And I think that's the thing that, I could point to most definitively.
Right, which is an interesting one because everyone claims to be in it for the long run when you're interviewing them. What are some of the ways you actually test for it that it's more, so a lot of people are, especially salespeople, are very good at selling themselves. Kind of how do you look through that as you look to either partner up with people or hire them?
The simplest way to solve that, part of it is interviewing, but more important than that, I think for a sales organization in particular, it's the incentive plan. Aligning incentives is the most important thing. You'll hear a lot, and I've been guilty of this, to say we don't know what the future holds, so let's solve to compensation plans that solve to the things that are controllable rather than the things that matter. Let's not solve to booked revenue because we don't know what's possible. Let's solve to opportunities created. Let's solve to, did you do a good job, MBO or OKR type outcomes. Salespeople who are in it for the right reasons and care about the outcome know that the only thing that ultimately matters is building a durable business. And the piece of the puzzle that they own is making sure that revenue growth is there. Anyone who's not willing to subscribe to an incentive plan that focuses on revenue as the North Star metric, even at the earliest possible days of the business, is probably not focused on the right thing, because that is the one thing that should matter to a person in that seat at that point. And I think I've learned to trust my gut more on that particular piece of holding people to the right standard, the right long-term standard of revenue, even when it feels shadowy and hard and nebulous and difficult to solve to early on in a company's life cycle. That's the kind of salesperson I want. The person who knows that that's the thing that matters and is willing to accept that as the yardstick that we measure them by.
It's hard enough to hire great people when you're an unproven early startup. This makes it even harder, but it pays off in the long run, as you say.
It does. It does. Recruiting is the hardest part of building a business.
The maybe a couple more things that you told me in the past that I found fascinating. One of them is tactics equals strategy when you're first figuring things out early on as a startup. What do you mean by that?
Yeah, look, you have to know where you're going, but you have to be able to get through today, right? Like the reality is tomorrow doesn't matter if you're not here tomorrow because you've run out of cash, because you weren't able to make the adjustments, the decisions every single day that get you to tomorrow. And so the further along in the company's life you get, the further out you can think, the more maneuvering room you have to get to 2 years, 3 years, 4 years out. At the very beginning, you have a very short-term right to live and exist as a company, and you need to be maniacally focused on learning one more lesson, winning one more customer, building one new feature, signing one new partner. Tactics in the short term, I think, is what makes you do that. You hear, I want doers, not thinkers, a lot in startups. And I think the translation for me is, I want people who can help me navigate through tomorrow more so than people who can help me get to next year. And by the way, if all you're doing is tactics and you're never thinking about where you're going, you might risk cutting your way through the wrong direction in the jungle, right? Like by the time you get out of the jungle, you might be in the wrong place. You still want to have somebody who's running up the tree and looking out ahead every now and then to tell you, are we cutting in the right direction or not? But you want people who can help you figure out how to cut the next tree really, really well and who are very good at doing that. And you want to constantly be stooping down to that level to think about that level of execution. It's not enough to say, this is the goal. You need to really get down to, if we need to win 100 customers, where are the next two going to come from? And how do we do that very specifically? If you're afraid as a founder, as an operator at a frankly, Series B startup to get down to that level of like ground floor thinking, you're probably not going to make it because no one else is going to be doing that for you instead. And you're going to be looking at, back to our earlier comment, a great looking spreadsheet with great operating assumptions that don't pan out because no one's making them pan out.
Another one that stuck with me was winning ahead of Series A is learning a ton very quickly, especially what not to do.
Yeah. Learning what not to do is, look, I'm a forever student, and I think most early stage operators are too, right? Like we thrive on learning, we thrive on problem solving, and we like being presented with situations that we haven't dealt with before and finding a way to address and overcome them. It's in our DNA. With that being said, I think if you assume that there is a finite amount of things to get right and an infinite amount of things to get wrong, everything wrong that you learn ideally gets you a little bit closer to one of the viable lessons that will help you build a better business and get something right. Just like in sales, we always talk about, collecting your no's. Every time someone tells you, no, I'm not signing up, theoretically is one less no you need to collect on your way to your next yes, right? And I feel the same way about learning the hard lessons in startup land. Every failure is an opportunity to not do that failure all over again. They talk about this a lot, like why are second-time founders better than first-time founders? Why do we talk about, wisdom of age? It's because you've made a lot of mistakes along the way. It's because your time to the right outcome is shortened by the fact that you know which paths not to take because you've already taken them before. And, in a world where we're so time constrained and where we have to get to where we want to go as quickly as possible, the less paths you have to walk down and the less mistakes you have to make along the way, the faster you're going to get to where you're going. So to me, right, the value of like those mistakes made compound, they add to wisdom over time that helps you run faster because you've seen the story play out before and you know what not to do.
The faster you learn, the faster you execute, or the faster you execute, the more you learn. And so when we diligence startups at the very start, when there isn't much there yet, learning velocity and execution velocity are two of the things we over-index on in our own diligence. And so that makes total sense.
Curiosity, everything.
Yeah, no, 100%. 3 more kind of quick questions before we wrap up. So if you give me a quick answer on them.
Sure, perfect.
First one being, what popular advice is often given to startup founders or operators that you disagree with and why?
Do what you love, I think is misguided for a lot of people. I think doing what you're good at is a superpower and leaning into what you're good at and learning to become passionate about what you're good at is a very, very underrated thing. You see this a lot in deep tech today. Rockets sound so interesting. I hate finance. Let me go and learn rocket building. You're going to have a much harder time building a great business than sticking to what you've had a whole wealth of experience in and become very good at. Do that. Do more of that. You can talk to rocket companies when you're an investor on the other side of your exit.
Yeah, very fair. This may be somewhat similar, so let me know if you don't have a different answer to it. But what's the one piece of advice you'd like to give someone who's thinking about starting a company or has recently started one?
If you think it's hard, multiply that by 100. It's way harder than you think. The only way you'll build it is if you're so passionate about the solution to the problem that you're solving that there is no giving up when things get hard because this business needs to exist. I love founders who are building what they're building because they have some personal life experience to solving that problem that means so much to them that they just cannot afford to fail. If you lost a loved one to cancer and you're making your life's work curing cancer, you're probably going to keep figuring out how to make it work when you're about to run out of money, way more so than the person who decided to do this business because they read that it was a good business and market opportunity. Find something that you can go the whole distance with and know it's going to be impossibly hard, 10 times harder than you think. If it still sounds worth it, jump in.
That makes sense. And then the last one, as a VC, I'm always curious to ask, what's the most impactful or thoughtful thing a VC has done for either you or any business you've been involved with to date?
Most founders think that they owe VCs. I've generally viewed it the other way around. Good founders know that they've given a right to a capital partner to take a seat aboard the boat for the ride, right? And that means that those seats are free. And of course, money is one part of the way that you buy the ticket, but there's a lot of other ways that you show value and justifying your seat on that boat. To me, the most valuable things most VCs can do is connecting founders with the right people in the market. VCs are the nexus that connects a lot of the players in our ecosystem, and not just saying, oh, I know a lot of people, but actually leaning in to make those introductions happen and facilitate more than introductions, facilitate deals and facilitate decisions is essential. We work very closely with Left-Lane, who led our Series A. I can contact our investors at Left-Lane, and I do on a regular basis, to ask them to connect me with other CFOs and founders that might be a viable fit for our product. And they don't say they're going to do it, they actually do it. And that's different than the experience I've had with a lot of partners on the venture side. Follow through is everything.
Thank you so much. This was incredible. And I learned a lot myself as well.